Welcome to Purdue Commercial AgCast. I am Joana Colussi, Research Assistant Professor in Agriculture Economics, and I'm here with Michael Langemeier, Professor and Director of Purdue Center for Commercial Agriculture. This is a special episode for us because we are recording the podcast for the first time from our office here at Purdue. We thought it would be a nice way to bring you a little closer to the place where we work every day. Today, we are breaking down the results of the March 2026 Purdue University CME Group Ag Barometer. Every month, we serve 400 farmers across the U.S. to learn more about how they are feeling about the farm economy. This month's survey was conducted from March 16 to March 20. But before you get started, be sure to like this video, subscribe to the channel, and turn on notifications so you don't miss future episodes. Let's take a look at this month's Ag Economy Barometer. The overall index rose 11 points from 116 in February to 127 in March. Both the index of current conditions and the index of future expectations also moved higher, with the biggest jump coming in the future expectation index, up 14 points from the previous month. Even so, that index remains 12 points below last December's reading and 16 points below its level in March of last year. Overall, though, we can say that U.S. farmer sentiment improved in March compared to the February. And that's especially interesting because since we have seen the outbreak of war with Iran, which is affecting global markets, including fertilizer prices. Michael, what do you think is behind that improvement now in March?
Well, certainly the impact of higher energy prices and higher fertilizer prices had a negative impact on sentiment, but there was other factors going on here, and one of them that we didn't talk about in the report that's obviously was going on is the bridge payments were going out. And the bridge payments, if you average those for a corn soybean farm, were about $35 per acre. And so they were rather sizable. And so that probably boosted sentiment. But also, if you look at corn and soybean prices, particularly corn prices were up. If you look at the time we surveyed in March compared to the time we surveyed in February. And one of the interesting things about corn prices is it's not perfectly correlated with energy prices, but it is positively correlated with energy prices. And so because the energy prices went up, corn prices went up a little bit, and I think that offsets some of the negativity regarding the higher energy and fertilizer prices. Another thing I think is important to point out is a lot of producers probably already had purchased their fertilizer, and so this isn't going to be quite as much impact for those people. There is people that hadn't. And then also, I would think that people that are going to put some of the fertilizer on in season, they probably hadn't bought all of that. And so I'm not saying the impact of the fertilizer prices is neutral, but it's not as big as you might think because people had probably bought quite a bit of their fertilizer before the war started.
Do you have an idea how much percent of the farmers bought the fertilizers for the coming season?
I just read someplace it was about 80%. I don't know how accurate that figure is.
That's a good amount.
Yeah, that'd be a very high percentage.
And we continue to see more optimism on the livestock side compared to crop production. Only 31% of respondents expected good times for crop producers, while 63% expected good times for livestock producers. And now let's turn to the Farm Capital Investment Index. That measure moved up 3 points this month, reaching 53 points. However, only 4% of survey respondents indicated that they plan to increase farm machinery purchase in the upcoming year. Michael, why are farmers still trying to avoid large investments, especially machinery?
I think if you look at the net returns, particularly for crop producers, they're very tight. And when you see relatively low net returns like this, they have a tendency to cover owner withdrawals and principal payments before they purchase machinery. That's just a natural way to think about cash flow. And usually there's not enough cash flow left over to seriously consider buying machinery in 2026. That was also the case in 2025, and so this index has been relatively low for the last 18 months. It's been really it's really been really ranging from about 50 to 60 for the last 18 months.
And is there an expectation that the situation could change in a short term?
It would take substantially higher prices than what we're seeing right now. It would probably, if you look at something like the iFarm price distribution tool, which kind of looks at the probability of prices would probably have to be in that upper quartile. There's a probability, 25% chance that prices could be high enough that you'd see more interest in buying machinery.
And the cost production of the situation.
Yeah, obviously
is-
that situation's actually worse, since the war, and it wasn't too good before that, and so break-even prices increased a little bit. Just to give you some example, some idea of that of the magnitude, if somebody hadn't bought their fertilizer and they were buying quite a bit of their fertilizer under these new prices, break-even price for corn would be about 10 to 15 cents per bushel higher.
Yeah, and that concern about cost production shows up very clearly in the response to the next question. Looking ahead to the next year, what's your biggest concern for your farming operation? The percentage of respondents who pointed to high input costs as their top concern increased from 44% to 46% this month. Concern about input availability also moved higher, rising from 8% to 11%. Michael, we are already seeing fertilizer prices moving higher because of the war with Iran, which could directly affect production costs we just talking about. Do you think these concerns are likely to grow in the months ahead? We know that this question is tough because we don't know what will happen.
If you look a year ago, the biggest concern was input costs, and it was about 40%. So it certainly has grown here in the last few months. It was at 44% in February, so not exactly a small percentage. And then further increase in March. I think it's going to stay around that 40 to 45% for the foreseeable future. And this is true for even for livestock producers, because if you were a feeder producer or someone that finishes cattle, one of your big expenses buying the cattle, buying the feeders, buying the calves or buying the feeders, and that's included in aggregate input price indices. And so input costs are going to be a concern for both crop and livestock producers moving forward.
So we can see some changes in this index. This month's survey included questions about inflation and interest rate expectations. Almost 40% of respondents expected inflation for consumers to be above 3%. When asked whether the U.S. interest rate would be lower, about the same, or higher 12 months from now, 34% of respondents indicated that the interest rates would be lower, while 16% said interest rates would be higher. Michael, it seems like farmers are still concerned about inflation, but at the same time expect interest rates to move lower. How do you read these results?
I think we're going to continue to ask this question because this is kind of a moving target. I've heard information, not necessarily coming out of the Fed, but those that watch the Fed very carefully, that they could reduce rates, but they could also increase rates because they're looking at inflation very closely. That's why we put both those questions in there this month. And so we're going to continue to ask this because I do think you're going to see some people on both ends of the spectrum. Some people are going to expect lower. That was kind of what we anticipated last year coming into 26, but there's also going to be that group that expect interest rates to be higher. And this is huge, not only because it impacts operating costs, but it impacts asset prices. And so it's very important to ask this question and relate it to land values.
That's another factor. So financial concerns were also clear in these questions when we asked farmers which type of risk they see as the biggest threat to their operation. 33% pointed out financial risk, followed by marketing risk and production risk. We have also other risks.
There's also human resource or labor risk, legal risk, and strategic risk, they tended to be 10% or below. And so the big three, which is typical, financial, marketing, and production. But when we've asked this question in the past, marketing usually is the first. And so the fact that financials the first really is an indicator again of how tight those margins are, particularly for the crop sector.
That's true. And from time to time, the monthly survey includes questions about leasing farmland for solar energy production. In this month's survey, 12% of farmers said that they had talked about leasing farmland they owned for solar development during the previous 6 months. Overall, 5% of respondents said that either they or one of their landowners had signed a solar lease. Michael, how should we analyze these numbers? Is solar leasing becoming a more common part of the conversation in the farmland use in the U.S.?
Yeah, we have a chart in the report that looks at the percentage that talked to someone about solar leases going back all the way to early 24, and a couple of those months it was close to 20%. Close to 20% of the respondents had been approached by somebody, and that was before the 24 election. And so we're really trying to gauge here, at least that's one of the things I was trying to gauge, did that fall off the cliff, in terms of the percentage that had been approached since the 24 election? And no, not really. It's still 12%. It was 11% in January 25 and 12% this month. And so there's still a lot of people being approached by solar companies about the potential of leasing ground for solar. One of the things that was interesting in the results this month, and we didn't put this in the report, but we did ask the question about what was the rate, and we had a lot of different buckets. It was all over the place. And so that's one of the reasons I didn't put it in the report, because it's hard to figure out exactly what's going on there. There was quite a few below 500. There was quite a few above 1250. There was about 30% that were above 1,250, but it was a very, very wide a difference between the high end and the low end in terms of those rates. And I think the way I interpret that is that probably these solar leases are people are being approached on these solar leases all over the Corn Belt and Great Plains. And if you go into areas where the cash rent's not as high as what it is in Indiana, you don't need to offer $1,000 because you compare it to the cash rent. And so my guess, we didn't ask this, but my guess is the lower rates are occurring in areas that have lower rent. And the Eastern Corn Belt here is where some of the higher rates are occurring, the rates over 1250, for example.
It's kind of still a new market that's developing, so many things going on. They are trying to adjust according to each situation that's different.
But we'll periodically ask that question at least once a year. We'll try to get a gauge on what's happening in the solar leasing.
To be able to compare.
Yes.
Yeah. So, and turning to farmland values, the short-term farmland value expectation index rose from 123 to 125 in March, marking its highest reading since May 2025. The long-term index also moved higher this month, rising from 150 to 159. Respondents identify alternative investments, net farm income, and interest rates as the three factors with the greatest influence on farmland values. I don't know if you have any additional comments in these results.
Yes, I'm actually working on an article that's comparing the characteristics and sentiment for those that expect land values to go down in the next 12 months and those that expect land values to go up in the next 12 months. And there's a couple things that are very interesting. And we'll put this out as an article on our website after the April 7th release. Essentially, one of the things that's happening is if you're a livestock producer, you're probably more optimistic about land values going up. That's very, very clear. But not surprisingly, those that expect land values to go up are quite a bit more optimistic, particularly about the index of current conditions. And that's leading them to think, well, the current conditions aren't that bad. So land values are going to go up in the next 12 months. If you look at the people that expect lower land values, they're very concerned about input costs, more concerned about input costs than the other group. But they're also really worried about net farm income. They said net farm income was the most important factor influencing land values in their area, and so there's just a lot of difference among producers. But because that index of current conditions was a little stronger, and that index of future expectations was a little stronger, I was not surprised to see an increase in the index, both the short-term land value index and the long-term land index. They tend to follow those two sub-indices, short-term obviously following index of current conditions, long-term following that index of future expectations. Now, it is important to point out that the long-term index is down a little bit from what it was in December, but it went up. It's quite a bit higher than what it was both in January and February, and so that leads me to believe, and we're going to get to this, that people are a little bit more optimistic about the current long-term policy environment.
That's a good spoiler for this article. When it will be running? It's in April. This article that you are writing?
Yes.
Yeah. Nice. So, and as we have done in recent months, we asked producers whether they believe the U.S. is headed in the right direction or on the wrong track. In March, 65% said that the country is headed in the right direction, up from 59% in February. Michael, would you say that this reinforced the improved sentiment we saw among producers in March?
When I saw the higher index of future expectations, I went right away to what happened to the long-term land values and what happened to this question, and they're very consistent. If you're more confident about what's going on 5 years from now, you're going to be more confident in where land values are heading and where the U.S. is heading, and so they're all very consistent with one another. They all saw increases.
They are correlated, connected some way.
And maybe those, we have to circle back to those bridge payments. Maybe those bridge payments, really made a lot of difference, not only short term but long term, because it really did. It really did change how they view land values when you see an influx of $35 per acre, for in terms of income for corn and soybean, farm. That's quite a bit. And so maybe that's also feeds into there somehow.
Yeah, we didn't touch so much in the exports chart, but we also can see some impact from that because we know that in January and February happened some shipments to China.
Yes, that's certainly positive too.
Yeah.
And as I said at the beginning, I mean, it wasn't just corn prices that were up; it was also soybean prices. Soybean prices weren't up as much, but just to give as a frame of reference here. If you look at U.S. cash prices for soybeans, they're up 90 cents to $1 per bushel since January. And you would think eventually that's going to have a positive impact on sentiment, and it has.
Yeah, probably. So those are the key highlights from this month's survey. You can find the full report on our website, and that we have included in the link in the description below. Thanks for watching, and be sure to like, follow, and subscribe so you don't miss future reports and videos from the Purdue Center for Commercial Agriculture. We hope to see you again next month.